just shut up and let me enjoy this pain.
Welcome to the pain zone. It's where we live.
When I'm hurt, I love it. I love that feeling because it's real.
You need to love pain.
Be the guy who embraces the ugly, the miserable. Be the guy who embraces hard work, the grind. Don't be afraid of being hurt. Don't be afraid to sacrifice some blood.
Everything else, happiness could be fake, crying could be fake, but pain? Shit. That's real.
However, mentally, physically, love it. You need to love it. If not, stay where you are.
Ladies and gentlemen, boys and girls, welcome to the show. I am your host with the most, Chase. And what a day, what a week, what a year it has been, except for today. Today was kind of muted in the normal trading hours until we got into the after hours, and then things got a little bit volatile. And we're going to talk about why. We're going to talk about some of the major movers we saw in the market today. We're going to talk about why that is and how it affects earnings, as well as the ongoing trade war. We're going to look at buyers and sellers of stocks this week, what retail was doing, the impact on the market, and then we're going to look at Louis Vuitton's latest earnings and some moves I'm making in my portfolio. But before we dive in, if you guys could please go ahead, like this video and subscribe. It really helps a small channel like mine grow. Let's dive in. And a quick recap of the market. We had a very trepid day. The S&P 500 was up, the Nasdaq 100 was down, but in a very tight range on a price-wise. This was in normal trading hours. We saw stuff like healthcare and consumer cyclicals fall. We saw stuff like sensitives, tech, financials gain, but it wasn't much of a gain compared to what we're used to. A very trepid day. Until we got into the after hours, then we saw some stocks move in a very big way, particularly some of the tech names. Nvidia was down 5.58%. ASML was down 1.24%. In the context of both of these stocks seeing gains of in excess of 1% in normal hours trading. And it all stemmed from Nvidia and a release we got from the management team. And I'm going to read this article here from the Capital Brief. Nvidia said Tuesday it'll take a charge of about $5.5 billion tied to its H20 graphics processing units after the US government informed the company it will require a license to export the chips to China and a handful of other countries. The notice was received 9th of April and the US government informed the company on 15 April. The requirement will be in effect for the indefinite future. That is what Nvidia said in a regulatory filing. The charges are related to inventory, purchase commitments, and related reserves for the H20 line. The H20, Nvidia's primary chip legally permitted for sale in China, was designed to meet previous US restrictions and generated an estimated $12 to $15 billion in revenue in 2024. The Biden administration restricted AI chip exports to China in 2022 and updated the rules in 2023 to block more advanced processors. Additional restrictions under AI diffusion rules first proposed by the Biden admin will apply starting next month, and Nvidia as a result was down 5%, bringing the entire market down with it. So they're going to take a $5.5 billion impairment charge, and this is going to tangibly affect revenue, not just for this quarter, but for the year as well. And this is Nvidia's EBIT figures right here. So they're looking at doing about $200 billion in sales this year, and that's going to convert to about $1.3 billion in EBIT. So a $5.5 billion impairment charge, we're looking at about a 3 to 4% hit to probably EBIT, I would say, and that is tangible. But what's going to be even a bigger impact is probably the number year on Q1 or the Q2 numbers. It just depends on where they decide to amortize that, thinking they're going to do it in Q2 here because it's the bigger figure. So with that $5.5 billion impairment charge, you're looking at about a 16% hit to EBIT. That's probably going to impact gross margins by about 10 to 12%. So not good at all. And that is why the stock was actually down 5% here in the extended hours, and probably will continue to slide tomorrow if the trade war escalates. And that's exactly what we're seeing. A couple on the weekend, China came out and said they are restricting exports of rare earth minerals to the US. And then as a result, Donald Trump signed a probe to investigate the reliance on imported critical minerals, rare earth elements specifically. Donald Trump taking this very, very seriously. 90% of all rare earth elements are processed in China, not mined, processed. But all this really does is bring to the forefront of how reliant the US is on China. And it probably means we are going to see escalations in this trade war to further onshore manufacturing and make the US less reliant on China as a whole. Furthermore, the EU and US actually had some negotiations today. They were talking, and apparently there was very little progress made. Nothing really came out of it other than the fact that we got this headline here that very little progress was made. But we do know that negotiations are happening. But if we don't start to get material movement, I think equities will continue to sell off, led by selling in institutions, because retail investors just keep buying the dip. Since Liberation Day, retail purchased about $13 billion worth of equity. Retail are really liking this dip right here, taking advantage of it, and we'll see who's going to be right. Will it be dumb money or will it be smart money? Now let's actually talk about a stock that just reported earnings, Louis Vuitton, and the stock did not act well after this earnings report, down about 7%, and that's because LVMH actually reported a negative 3% decline in year-over-year revenue for the quarter versus the expectation of about 2% growth. And when you get a huge miss like this, the stock is not going to act well, and the stock is not going to act well for the quarter. And as a result, luxury stocks were also down in a very big way as well. And LVMH is no more the biggest luxury brand in the world. It is now Hermes, worth $276 billion. LVMH about $200 billion in market cap under that. So it really goes to show the changing of the guard, I guess. However, you can see that at its peak, LVMH was worth $500 billion. Now let's actually talk about why and where the bleed was in the financials. As you can see right here, LVMH saw revenue declines across a large part of its segments. A lot of it was flat on a year-over-year basis, and only one segment was up. Now, the biggest segment is fashion and leather goods right here, worth about $10 billion to the group. They saw declines of negative 4%, wine and spirits negative 8%. So this is currency adjusted and this is organic. So currency adjusted slightly better, organic slightly worse. Perfumes and cosmetics was flat, but if you adjust for currency, down 1% on an organic basis. Watches and jewelry actually gained 1%, flat organic. And then selective retailing, which is actually the second biggest segment, that includes stores like Sephora, was actually flat as well. And then this year is negligible. All in all, we saw a negative 2% currency converted decline, a 3% organic decline. And if you actually look at it, the majority of the selling was actually from the Asia segment right here, excluding Japan. Now, this is very, very interesting because in 2024, LVMH as a group said that they would not increase prices at all. So to actually see the group down 11% goes to show that it's not just like unit economics because of inflation. There's actually a volume reduction in the Asia segment. However, when you look at Europe, plus 2%, and there was very minimal price increases in the group, that really goes to show that they probably did see volume increases and probably a lack of discounting, right? Japan was down at 1%, and that's probably because volume stayed steady, and then inflation costs associated with that and the time value of money, very, very resilient if you ask me. In the United States, down 3%, and I'll put that to, again, input costs rising without any price increases, and then I would say steady volumes means you're going to see the US down 3%. So all in all, like these results, US, Japan, and Europe, if you actually dive into the weeds as to what LVMH did this year, not bad at all. However, the Asia segment seeing probably heavy discounts, volume declines, that all has to do with China. Not a good look for the group. And until China actually gets their story together and the consumer comes back to the product, we probably will continue to see this type of growth in the Asia segment. Actually, maybe not double-digit declines, but declines or really just trepid growth in the near term. And there's definitely other opportunities out there when it comes to the luxury segment. You see, LVMH does have a number of luxury brands, but the majority is more like below the aspirational tier. Even if they were to increase prices, pricing power is very, very limited. And that is why I've never really bought into LVMH. However, I did recently buy a luxury stock and it was Prada. And there's very many reasons for that. But I wrote a piece here breaking down why I actually bought Prada. and I put it on Twitter. So let's go ahead and read, right? So I made Prada 2.3% of my portfolio, and this is why. Prada trades at a 35 to 50% discount to all of its peers across almost every valuation multiple. The main reason, it's listing on the Hong Kong exchange, but the business fundamentals tell a different story. Prada grew revenues by 17% last year with 80% gross margins, while the luxury industry as a whole shrank by 1%. So I got a comparison chart right here of some of the major names. So we have Prada, LVMH, Hermes, and Kering, which is like Gucci pretty much. And you could see revenue growth here by Prada, 17%. The best out of all of these names right here. Gross margins for Prada was the highest, even outpacing Hermes. We had 79.8% in gross margins. EV to EBITDA stands at 9.5 times. That's even lower than LVMH, lower than Hermes, and just higher than Kering, but roughly in the same ballpark. The PE ratio, it has the lowest out of all of these names, and look at its free cash flow yield, 6.4%. Now, Kering's is a little bit higher, which means the stock on a free cash flow basis probably is a little bit more attractive. But when you actually look at the revenue growth right here versus what Kering did, that is why we're seeing the discount in Kering. And out of all of these stocks, if you were to look at them and say, hey, which one would you want to buy? You're probably going to go ahead and buy Prada or hold Hermes. And Hermes is actually growing less, far more expensive with lower gross margins and a lower free cash flow yield. Prada is the obvious buy, at least on a valuation standpoint. But let's actually talk about why I actually went and bought this stock right now. Prada's second biggest segment, Miu Miu, now accounts for 2.5% of group revenues. It grew 93% year over year in 2024. Now, this growth will slow in 2025, but even then, Miu Miu is expected to grow in the low to mid 20s range. Impressive in this tough luxury environment. And you can even see here that the Prada group actually saw 4% growth. So the namesake brand was up 4% on a year-over-year basis, unlike LVMH, which actually saw declines. Miu Miu grew 93%. Their Church's brand grew 10%. Their car shoe brand grew 9%. So it really goes to show that it's not just Miu Miu driving growth. It's actually Prada itself, Church's, as well as all of their other segments. They have 2 or 3 segments in here. They also have a sailing team. And it really goes to show, guys, very strong organic growth. It's a plus 18% growth here via retail sales and actually 17% in total revenue. Very, very good figures. You love to see that. Now, last Friday, Prada announced it's acquiring Versace for $1.37 billion, 1.25 billion euros. And when you break down the numbers, it looks like legitimate. Now, Versace reported a 64 million EBIT loss on 806 million of revenue last year. That doesn't look too good on a headline number, but when you dive in, that was because of a 590 million non-cash impairment charge, mostly for goods and intangibles, as well as an asset write-down. And when you adjust for that and normalize costs using peer benchmarks, right, I use these benchmarks right here, you can conservatively estimate EBITDA margins of 35 to 40% or 262 million in adjusted EBITDA. When you apply a conservative 8x EBITDA multiple to that, you get a 2 billion valuation. They bought Versace for 1.37 billion. Now, here's the math, right? If Prada can simply integrate and operate Versace as is, they can then pretty much automatically unlock $726 million worth of value in the next 6-12 months out of Versace, and the market isn't pricing that in because Versace's top line has been bleeding. The top line has been declining, and so the turnaround won't be easy. The Versace brand has not been in a good place. The brand as a whole has deteriorated. It's up to Prada to reinvigorate it. And the reason why is because, Capri Holdings, the parent company, has just neglected the brand. It was underinvested in for years, way too much discounting, way too much wholesaling. And now Prada has to clean it up. And to be honest, Prada are the people to clean it up because the Miu Miu brand was exactly the place Versace was in 2021. And now look at Miu Miu growing 93%. And it's the number 1 brand in the world, according to this list right here. Now, with regards to this, Prada have also earmarked $250 million for the turnaround. And what they're going to do is close unprofitable stores, shift away from wholesale, and reinsert Versace into the culture. It won't be quick, but I believe the below industry multiple plus the actual purchase price of Versace limits downside. All that's needed now is middle of the road execution. And if they can deliver that, that's meaningful upside ahead. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.